Political elections often trigger heightened volatility in stock markets. Investors closely monitor campaigns and results, reacting to potential policy shifts. A pro-business candidate might boost investor confidence, leading to a rally in stock prices. Conversely, a candidate perceived as less business-friendly could cause market jitters, leading to a sell-off. Historical data provides numerous examples, such as the 2016 U.S. presidential election, where Donald Trump's victory led to a significant rally in U.S. stock markets, particularly benefiting industries like finance and energy, which anticipated deregulation and tax cuts. Government bonds are another financial instrument sensitive to election outcomes. The bond market's reaction often hinges on the perceived fiscal responsibility of the candidates. If an election outcome suggests higher government spending and larger deficits, bond prices might drop, leading to higher yields. Conversely, an election signaling fiscal conservatism could bolster bond prices. During periods of high political uncertainty, investors may flock to safe haven assets, including government bonds, gold, and stable foreign currencies. This flight to safety underscores the deep connection between political stability and financial market performance. One of the most direct ways elections impact the economy is through changes in fiscal policy. Governments may alter tax policies, public spending, and budget priorities based on the election outcomes. Expansionary fiscal policies, such as increased public spending or tax cuts, can stimulate economic growth in the short term, but might lead to higher deficits and long-term debt. For example, significant tax reforms followed the 2017 U.S. Tax Cuts and Jobs Act under the Trump administration, leading to increased corporate profits and investment, but also contributing to higher budget deficits. While central banks are generally independent, election outcomes can influence monetary policy indirectly. Political leaders appoint key positions within central banks, and their economic philosophies can shape monetary policy direction. In emerging markets, political stability is crucial for maintaining investor confidence in the central bank's ability to manage inflation and currency stability. Political turmoil can lead to capital outflows and increased inflationary pressures, challenging the central bank's policies. Political uncertainty often causes businesses to delay significant investments. Companies prefer a stable and predictable policy environment to make long-term investment decisions. Election periods can therefore see a slowdown in business investments, particularly in sectors heavily reliant on government policies, such as energy, healthcare, and infrastructure. The Brexit referendum in 2016 is a case in point. The uncertainty surrounding the UK's future relationship with the EU led to a significant slowdown in business investments, impacting economic growth in the subsequent years. Consumer confidence is another critical factor influenced by political stability. Stable governments foster higher consumer confidence, encouraging spending and boosting economic activity. In contrast, political uncertainty can lead to cautious consumer behavior, with increased saving and reduced expenditure. For example, political unrest in countries like Venezuela has led to severe economic contractions as consumer and business confidence plummeted, exacerbating the economic crisis. Elections can lead to significant shifts in trade policies, impacting international trade relations. Protectionist policies, such as tariffs and trade barriers, might benefit domestic industries in the short term, but can harm international trade and lead to retaliatory measures from other countries. The U.S.-China trade war initiated during the Trump administration is a prominent example. The imposition of tariffs led to disruptions in global supply chains, impacting businesses and consumers worldwide. Political stability and favorable policies are critical in attracting foreign direct investment, FDI. Elections that result in a stable and investor-friendly government can boost FDI, driving economic growth and job creation. Conversely, political instability or unfavorable policy changes can lead to capital flight and reduced foreign investment. Emerging markets in particular are sensitive to political stability. Countries like Brazil and India have seen fluctuating FDI inflows based on the political climate and government policies. Different political parties have varying stances on regulation, impacting industries differently. Deregulation can benefit sectors like finance, energy, and telecommunications by reducing compliance costs and encouraging investment. On the other hand, increased regulation can impact industries such as technology and healthcare, aiming to protect consumers and ensure fair competition. For instance, The Dodd-Frank Act's rollback under the Trump administration was seen as a move to ease the regulatory burden on the financial sector, potentially boosting profitability and investment in the industry. Changes in labor laws, such as minimum wage adjustments and labor protections, can significantly influence employment rates and business costs. Governments focused on worker rights might implement policies that increase labor costs for businesses, while pro-business governments might prioritize labor market flexibility. The increase in minimum wages across various states in the U.S. reflects the impact of political decisions on the labor market, influencing business operating costs and employee livelihoods. Election outcomes can determine the level of infrastructure investment, influencing long-term economic productivity and growth. Governments prioritizing infrastructure development can stimulate economic activity, create jobs, and enhance productivity through better transportation, energy, and communication networks. China's massive infrastructure investments, driven by its political leadership, have played a crucial role in its rapid economic growth and development over the past few decades. Policies on education and innovation are critical for long-term economic growth. Governments that invest in education and support innovation create a skilled workforce and foster technological advancements, driving economic progress. Countries like South Korea and Finland, with strong education systems and innovation policies, have seen significant economic growth and development, showcasing the importance of these investments.